So this video is going to be on notes receivable and notes payable. And as you can see here, I have a simple promissory note to make it feel as though that this is a real scenario that we're working on. And as you can see here, this is a promissory note, and a promissory note is a written promise to pay a specific amount with interest or plus interest at a future date. And so you can see here, I have the city and state. I just made that up. And you have a date here on September 30th, 2021. This date here is, okay. This date is an issuance date. So this is the date of when the promissory note was issued out between the lender and the borrower. Frankie Frank Company, this is the borrower. Agrees and promises to pay to Kevin's Bubblegum Company. This is the lender. The sum of $40,000. $40,000 is the principal amount. For value received with interest at the annual rate of 5%. Okay, so 5% is the annual rate and it is the interest. So not only the borrower has to pay back the principal amount of $40,000, the borrower will also need to pay interest to the lender. So I like to just break this down by showing you all what it looks like on the lender's sides, the lender's books, and also the borrower's books. Okay, so the lender, I'm going to put on here receivable. Borrower, I'm going to put over here payable. Okay, so the first thing that needs to happen is the lender and the borrower will need to record the issuance of this note of $40,000. So I'm going to set up the general journal here for both lender and the borrower. So we're going to put on here the date, general journal, DR, not for doctor, for debit, and CR for credit. Okay, same with the borrower side, put in dates, general journal, DR, and CR. All right. So for the lender is the one that's lending the $40,000 to the borrower. And this happened on the issuance date, September 30th. So on 9/30, to record the issuance of the loan, we're going to credit cash for $40,000. And the debit is going to go to, well, since this is a note and the lender is expecting to get paid back the $40,000 plus interest, the debit is going to go to notes receivable for $40,000. Okay, note receivable is an asset. On the borrower side, on that same date, the borrower will receive the cash from the lender, so cash is going to be debited for $40,000. And the credit, since the borrower owes the money, meaning the borrower needs to pay it back to the lender, the credit is going to go to notes payable for that same amount. Right. Now, the next thing we need to do is figure out how we're going to record the interest here, because the interest is going to be accruing for a few months here from the issuance date up until the date of when everything needs to be paid back, which is principal and interest, which is December 31st. So when it comes to figuring out the interest part, we need to, well, I like to take it step by step. First thing I need to do, that I would like to do, is actually figure out what the total interest that needs to be paid on this loan. So what I'm going to do is take 40,000, which is the principal, Then I'm going to multiply by 5%. This is the annual rate. And I'm going to multiply it by 3 out of 12. Okay, what does this 3 mean? This 3 is going to be from October 1st to December 31st. So it's going to be for 3 months of interest that we need to accrue, and also that needs to be paid. So 3 months, and that's going to give us $500. Now the reason why we are using 3 out of 12 is because this here is the annual rate, so 12 months. But we only need 3 months out of that 12 months because the note was issued on September 30th, and we just need to pay it back by December 31st. So we only have the note out for 3 months. So we only need to record interest of 3 months. That's it. So $500 is the total for 3 months. So that's number one. Number two, we got to break this down by 3 months because in the company's books, the lender and the borrowers, we're going to actually record this $500 into 3 increments or within in 3 months. So we're going to divide it up into 3. So $500 divided by 3. Okay, that's divided by 3 months to get our monthly interest that we need to record in the lender and the borrower's books. That's going to be $166.66. But what I like to do is just round it up by the nearest whole dollar or whole amount. And that's going to be $167. Okay, that's how much it's going to be per month that we need to record in interest on the lender side and also on the borrower side. Okay. So just remember, this is just rounded. This is rounded, $167. So at the end of October, we know that interest has accrued for 1 month. And so since interest has accrued, we need to report that in both the lender's and the borrower's books. So since interest accrued of $167 for 1 month, we're going to record the receivable in the lender's book. So the account that's going to be debited is going to be interest receivable. And it's going to be for $167. And interest receivable is an asset. And the account that's going to be credited is going to be interest revenue for that same amount. On the borrower side, borrower needs to recognize the expense in their books by debiting interest expense for $167, crediting interest payable for that same amount, $167, and interest payable is a liability. Okay. On November 30th, the second month has expired, but interest has accrued, even though cash has not been exchanged yet. So what should we do? We should do the same or record the same entry as we did in October by debiting for the lender interest receivable of $167 and then crediting interest revenue for that same amount. Okay, on the borrower side, same entry that we need to that we recorded in October 31st needs to be recorded in November 30th by debiting interest expense for $167, crediting interest payable by $167. Right? So notice cash has not been affected in the October 31st entry and the November 30th entry. And that's because these are accruals that are being made, because this is both parties, so both lender and borrowers are reporting what happened throughout the time. In other words, they're recording interest over time that needs to be paid eventually by cash in the future. Okay, so what do we have here? December 31st. So this is it. December 31st is when the cash payment was made by the borrower to the lender. So this is it now when it comes to figuring out, well, not figuring out, but this is it. This is going to be the last entry when it comes to this promissory note. Okay, so we got to do a couple of things here. So I like to start off with the accounts that needs to be, that needs to be credited first on the lender side. So on the lender side, the first thing I like to do is look at the receivable balance on a notes receivable account. So the notes receivable on September 30th, we started off with the debit of $40,000. So since the cash payment was received by the borrower on December 31st, we need to go ahead and eliminate this note receivable balance here of $40,000 that's debited to that account. So to eliminate it, we got to credit it. So note receivable is going to be credited for $40,000. Okay, that's going to eliminate that balance that we recorded on September 30th. So that's number one. Number two, we have some interest receivable here that we did record in October and November 30th. So these two entries here that's shown, or these two items here in interest receivable that was recorded in October and November will also need to be eliminated as well. Okay, so we're just going to have to take 167 from October 31st plus 167 from November 30th. That's going to give us $334. So interest receivable needs to be credited for that amount. $334. That's going to eliminate these two balances here that's shown in October and November in interest receivable. So that's number two. Number three, well, we need to record interest revenue for the month of December of 167. So interest revenue is going to be credited for 167. Okay, so we got three accounts that are credited. And the reason why interest revenue is credited for 167 is because, well, in October, we accrued the interest of 167 in revenue. November 30th, we did the same thing. In December, that's no different because that's still another month of interest revenue that needs to be reported, right? So the next and last thing on the lender side that we need to do is we need to record the cash that's received. And the cash that's received is going to be the principal balance of $40,000 plus the interest that have been accruing in the company's books since October 1st. So since October 1st to December 31st, we have $40,000 plus 334 plus 166. That's going to give us a debit of $40,501. Now remember, this is rounding. This 167 is a rounded amount. Okay, so this is why we have a total cash of $40,501. So technically, this should be $40,500, but since this 167 is rounded, this is why we have 501. So the cash that's received is $40,501. On the borrower side, everything is going to be the complete opposite. So since we've already figured out what the cash amount is, was on the lender side, I can go ahead and credit cash, okay, for $40,501. Now, when it comes to the notes payable, we see that there's a credit of $40,000. Well, since the cash was paid to the lender, then the borrower can go ahead and wipe this payable out. So notes payable is going to be debited for that amount. Notes payable is going to be debited for $40,000. All right, so that's going to eliminate the balance in that notes payable account. Then next up, we have interest payable. We see that we've accrued interest here in October and November of $167 each. So we add those two together. That's going to give us $334, which means that we're going to go ahead and debit interest payable by $334. That's going to eliminate the payable balances. Then, since this is another month, we're going to also have to record interest expense for $167. So when you add notes payable plus interest payable and interest expense up, you're going to get a cash amount of $40,501. So you can see here, if I can just zoom out just a little bit, if it will let me, there we go. You can see how what it looks like on the lender side and what it looks like on a borrower side when it comes to accounting for a receivable and also accounting for a payable.